Hello everyone, thank you for tuning in again. Today I want to revisit the fascinating world of real estate investing, but with a fresh twist. We'll reinforce the core concepts many of us already know, like flipping houses, buying rental properties, and even wholesaling. But we'll also dive a bit deeper into how these strategies can work in different market conditions, and how you can apply some creative approaches. If you're looking to expand your keywords bank, think of terms like cash flow, mortgage, ROI, tenant screening, property flipping, BRRRR method, and house hacking, just to name a few. These words capture the essence of real estate investing. But remember, none of this is formal financial advice. Always do your due diligence, consult professionals when needed, and make decisions that fit your unique situation. Let's dive in. I want to start by highlighting why real estate is often considered one of the most powerful wealth building tools available. First of all, real estate is tangible. It's not just numbers on a screen, it's a piece of the earth that you can touch and improve. Second, it can provide multiple streams of potential profit. If you purchase the right property in the right area, you could benefit from monthly cash flow if you turn it into a rental property. And you could also see appreciation in the property's value over the long term. Let's not forget about tax benefits such as depreciation and potential deductions for mortgage interest and property taxes, which can significantly reduce your taxable income. But with all these advantages come responsibilities like property management, maintenance costs, and market fluctuations. So the trick is to find an approach that aligns with your goals, risk tolerance, and resources. One popular method is property flipping, sometimes known as fix and flip. The basic idea is straightforward. You buy a property that's undervalued or needs substantial renovation, you fix it up, and then you sell it for a higher price, ideally a lot higher, pocketing the difference as profit. This model can be lucrative if done correctly, but let's talk about what correctly means. First, you need to nail down the after repair value, ARV. This is essentially the price you believe the property will sell for once the renovations are complete. To get a realistic ARV, you study comparable properties, comps, in the neighborhood, what they sold for, what condition they were in, and how long they took to sell. Next, you estimate the cost of repairs, factoring in both materials and labor. Because unexpected costs like hidden mold, outdated wiring, or structural issues can pop up, it's wise to add a contingency buffer, say 10% or 15% of your rehab budget, just in case. Once you subtract the estimated repair costs and your desired profit margin from the ARV, you'll have a maximum allowable offer, MAO. If the seller won't budge below that, you pass on the deal. Yes, it takes discipline to walk away when the numbers don't match, but discipline is key to avoiding losses in real estate investing. If you prefer a more passive route that can build wealth over time, consider a buy and hold strategy with rental properties. The fundamental concept is to purchase a house, condo, duplex, or even a larger multifamily building and rent it out to tenants. Your monthly rental income should ideally exceed your expenses, including the mortgage, property taxes, insurance, and maintenance costs, thereby generating positive cash flow. Over time, you could also see capital appreciation as the property's value increases. But being a landlord involves more than just collecting checks. You have to screen tenants thoroughly, handle maintenance, or have a property management company do it, and deal with occasional vacancies. Yet, the long-term rewards can be significant. Many investors see rentals as a path to financial freedom, because once a property is fully paid off, the cash flow can be substantial. Even if you keep a mortgage on the property, as long as it's covered by the rent, plus a healthy margin, you can enjoy monthly profits, build equity, and potentially leverage that equity to buy additional properties. Another strategy which some find particularly exciting due to minimal initial capital requirements is wholesaling. In wholesaling, you act as an intermediary. You identify a property with a motivated seller, perhaps someone who's facing foreclosure or just needs to offload a property quickly, and you put that property under contract at a favorable price. Then, instead of actually buying and fixing up the property, you assign the contract to another buyer, often a fix and flip investor or a buy and hold landlord, for a fee. This fee is the difference between the price you negotiated with the seller and the price your end buyer is willing to pay. The upside is that you don't need to invest significant money for a down payment or rehab. The downside is that it can be very competitive and you need strong networking and marketing skills. You also need to understand contracts and local laws so you can properly assign the deal without running into legal trouble. Wholesaling can be a great entry point for newcomers who want to learn negotiation, marketing, and valuation without taking on the risks and responsibilities of property ownership. Let's talk about keywords related to creative financing. Terms like hard money lenders, private money, seller financing, and subject to deals can open up more opportunities when you don't have large amounts of capital or ideal credit. Hard money lenders specialize in short-term loans, often used for fix and flip projects, though their interest rates are higher than traditional mortgages. Private money could come from friends, family, or colleagues who want to invest in real estate but lack the time or know-how to find or manage a deal themselves. Seller financing means the owner of the property effectively becomes your bank, letting you make monthly payments directly to them instead of a traditional lender. A subject to deal involves taking over the existing mortgage payments, although legalities can be complex. All of these methods have pros and cons, and you must do thorough due diligence to ensure you're comfortable with the level of risk and the terms involved. Because real estate is so location dependent, you'll often hear the phrase location, location, location. This is no cliche. A property's neighborhood can significantly impact its rental demand, resale value, and overall ROI. An up-and-coming area with strong job growth, good schools, and improving infrastructure could make for excellent long-term appreciation. On the other hand, a declining area with high crime or waning employment opportunities could drag down rents and property values. Look at local economic indicators, population trends, and city or county development plans. What industries are moving in or out? Are there any large construction projects that might improve the community's appeal? Understanding these factors helps you avoid getting stuck with a property that struggles to attract quality tenants or that stagnates in value. Now, let's revisit a few lesser discussed but highly relevant approaches: the BRRRR method and house hacking. BRRRR stands for buy, rehab, rent, refinance, repeat. You buy a distressed property, fix it up, rent it out to reliable tenants, then refinance based on the new, higher value. The bank gives you a new loan reflective of that higher valuation, and ideally this allows you to recoup most or all of your initial capital. You can then use that money to purchase another property, and so on. It's a powerful strategy for scaling your portfolio quickly, but it requires careful planning, a reliable rehab team, and a good relationship with lenders who understand your approach. House hacking is another interesting strategy. You buy a property, live in one part of it, and rent out the other rooms or units. This can significantly reduce or even eliminate your personal housing costs, leaving you more money to invest elsewhere. House hacking is especially popular with younger investors who want to break into real estate without taking on a full-blown rental property right away. Risk management is a crucial topic in real estate investing, no matter the strategy. You can mitigate many issues by conducting thorough inspections, performing detailed market analyses, and staying on top of maintenance. Also, if you're renting, rigorous tenant screening can prevent a multitude of problems down the line. For flips, having a realistic timeline and budget buffer can save you from going over budget or carrying costs for too long. In any real estate deal, building a solid network is invaluable. Real estate agents, contractors, property managers, and mentors can all provide you with valuable insights that may save you money and time. Your network can also help you find off-market deals, which can be more profitable than properties listed on the MLS where competition is fierce. Mindset and discipline are sometimes overlooked, but are as essential as the financial aspects. Real estate can test your patience, your resolve, and your ability to stay calm when things go sideways. A flip can go over budget, a tenant might stop paying rent, or the market might temporarily dip. Successful investors view these as learning opportunities rather than signs to quit. They analyze what went wrong, adjust their strategies, and keep moving forward. It can help to keep a journal or spreadsheet to track each deal, noting key metrics, decisions made, and any lessons learned. Over time, this data provides you with a clearer understanding of what works and what doesn't in your specific market. It also helps you refine your approach so that each transaction gets a bit smoother and more profitable. Another key point is to have clear exit strategies for every deal. Let's say you plan to flip a house. What if the market cools and you can't sell at your desired price? Could you rent it out and turn it into a buy and hold property temporarily? Or if you're buying a rental property, do you have the option to sell to another investor if you need to liquidate quickly for any reason? Having these contingency plans in place reduces your risk and gives you options if circumstances change. Scaling up is an exciting topic for many people who find themselves hooked on real estate investing. Once you master a particular strategy, be it flipping, rentals, or wholesaling, you might want to expand your portfolio or move into different niches, such as commercial real estate, multifamily apartment buildings, or even short-term rentals. Think Airbnb and VRBO. Each niche has its own learning curve, market dynamics, and regulatory landscape. For instance, short-term rentals can be lucrative in tourist-friendly locations, but some cities have tight restrictions or high permit costs. Commercial properties can yield higher returns with triple net leases, where tenants cover most expenses, but they also require more experience and capital. Multifamily properties allow you to scale more rapidly under one roof, but you need to carefully analyze vacancy rates, property management complexity, and local rent control laws. Regardless of the niche you choose, remember that real estate is a business first and foremost. Treat it with professionalism, and it can serve you well. Let's also talk about partnerships. Some investors team up with friends, family members, or business associates to pool resources, capital, expertise, or labor. This can allow you to tackle bigger projects than you might manage alone, but it also introduces a layer of complexity. How will you structure the partnership? Who's responsible for day-to-day tasks like property management, rehab oversight, or bookkeeping? How will you split profits? A clear, written agreement is essential to prevent misunderstandings or conflicts. It's also wise to have a legal professional review your arrangement. Partnerships can accelerate your investing success if done right, but they can also strain relationships if expectations are not met. Before wrapping up, I want to emphasize once again the importance of doing thorough research, your own due diligence. Read books and articles, follow reputable real estate blogs, listen to podcasts, and, if possible, seek out a mentor who has walked the path you want to follow. If you're planning a fix and flip, visit multiple local projects to see the level of finishes and how various rehab budgets are allocated. If you're venturing into rentals, take time to understand tenant-landlord laws in your state or municipality. If you prefer wholesaling, study marketing tactics to find distressed properties and build a robust list of end buyers. Each strategy has its own set of best practices and pitfalls. The more prepared you are, the easier it is to navigate challenges that arise. Many beginner investors are concerned about timing the market. While buying at the bottom of a cycle and selling at the top is ideal, it's nearly impossible to do with perfect precision. Real estate markets can shift due to interest rates, employment trends, government policies, and broader economic factors. A more pragmatic approach might be to focus on deals that make sense right now under current conditions. If you're investing for the long haul and your property has strong fundamentals like positive cash flow and a solid location, short-term fluctuations may matter less. If you're flipping, tighter timelines and narrower margins might be riskier in a volatile market, so you'll want to be more selective about which projects you undertake. Always run multiple scenarios. What if the market dips by 5% or 10%? Can you still break even or turn a profit? Above all, remember that real estate investing is not a sprint. It's a long-term game that rewards patience, consistency, and ongoing learning. You may encounter setbacks, such as a deal falling through or a contractor going over budget, but these are par for the course. Each challenge can teach you something valuable. Over time, you can build a portfolio that provides passive income, appreciates in value, and acts as a hedge against inflation. You can diversify your holdings across different markets or property types, which can reduce your overall risk. The key is to stay focused on your strategy, keep an eye on your finances, and adapt when the market environment changes. If you're new, don't be afraid to start small. Maybe try house hacking to get your feet wet. Live in one unit of a duplex and rent out the other. You'll learn about property management firsthand while offsetting your living costs. Alternatively, you could begin by wholesaling smaller deals in your area to build capital and create a network. Or, if you have some savings, consider a single-family rental property in a stable neighborhood. Each of these paths can be a stepping stone toward larger and more complex real estate endeavors. The important thing is to start somewhere, learn from every transaction, and grow your expertise step by step. At this point, you might be thinking, this all sounds great, but how do I actually find deals? The answer isn't glamorous. It's about networking, consistent marketing, and becoming a local expert. You might drive for dollars, meaning you cruise around neighborhoods looking for properties that appear neglected. You can knock on doors, send direct mail campaigns, run targeted ads online, or attend local real estate investment groups. Over time, you'll build a reputation and a pipeline of leads. If you can become known as someone who closes deals quickly and fairly, sellers and other investors will remember you. That's how you start getting calls about off-market deals, which can often be more profitable than properties listed on the open market. Lastly, don't underestimate the value of patience and resilience. Real estate isn't about getting rich overnight. Though you might see stories of someone making a fortune on a single flip, those are exceptions, not the rule. More common is the investor who buys multiple properties over the years, carefully manages them, refinances when the time is right, or sells one to fund a bigger project. With each move, they're increasing their net worth and cash flow slowly but surely. Keep that long-term perspective in mind, and you'll be more likely to stick with it through the inevitable ups and downs. So that's a wrap for today's refresher. We've touched on property flipping, buy and hold rentals, wholesaling, creative financing, the importance of location, risk management, mindset, partnerships, and how to scale your portfolio. We also introduced keywords like the BRRRR method, house hacking, hard money lenders, and due diligence. As always, the best thing you can do now is to go out and keep learning while putting these concepts into action safely and prudently. Start small, treat it like a business, and remember that every mistake can be turned into a learning experience. Real estate investing has created significant wealth for countless people, and it can do the same for you if you approach it with seriousness, persistence, and a willingness to adapt. Thank you for watching, and I hope you feel empowered and excited about the prospects of real estate investing. Until next time, stay curious, stay informed, and keep exploring those opportunities.